Double bottoms are one of the most recognized chart patterns in trading. But if you enter a position the moment a stock's price touches that second bottom, you are walking right into a trap. Buying at that exact moment carries a massive 64% failure rate. To solve this, we have to look for a highly specific variation of the pattern. It is called the Eve and Eve double bottom. Comparing the general double bottom with the Eve and Eve setup, the standard pattern fails 64% of the time. The Eve and Eve variation drops that to just 4% in a bull market, yielding an average price rise of 40%. Step by step, we are going to learn how to correctly identify this exact visual pattern, map out a strict entry trigger, calculate a mathematical profit target, and manage the final exit. By combining patience with precise visual identification, you can bypass the 64% failure trap and execute a high-probability trade. Let's look at the charts. This chart shows the difference between Adam and Eve price bottoms. The Adam bottom is narrow, sharp, and forms a distinct V-shape with a sudden downward spike. Eve bottoms are much wider, making a gentle, rounded, U-shaped turn. During the first Eve bottom, institutional buyers decide the stock is a steal. Their buying demand absorbs panic selling, flattening the price into a rounded floor. After a middle peak, smart money steps back in, forming a second rounded turn. This prolonged accumulation makes the Eve shape highly stable. It is the literal footprint of institutional buying, unlike the unpredictable volatility of an Adam spike. First, look for a clear downward trend leading into the first bottom. Next, the vertical rise from the left bottom to the middle peak must be at least 10%. Finally, the bottoms must be 2 to 7 weeks apart. This timeline outlines a 52-week price range. For maximum performance, look for patterns where the breakout occurs within the lowest third of the stock's yearly low. Statistically, this is your optimal buy zone. Now check the volume. This subchart shows the trading volume throughout the pattern's formation. You want to see the overall volume trending downward, or forming a U-shape that mirrors the price action. Commonly, the left bottom has higher volume, but patterns where the right bottom has the heavier volume actually show exceptional post-breakout performance. If the prior trend, the 10% peak, the spacing and variance, and the volume all align, the pattern is mathematically valid. The sellers are exhausted and the setup is ready. Enter into trade at the bottom of the second curve triggers that massive 64% failure rate. We need a confirmed entry. This chart shows the confirmation line. Find the highest peak between the two bottoms and draw a horizontal line straight across. Your exact entry trigger happens when the price crosses and closes above this line. Once entered, use the measure rule to set your profit target. Visually take the vertical height from the lowest bottom to the confirmation line and stack that exact distance on top of your breakout point. The close above the line guarantees the required strength is present, and the measure rule gives you a precise, emotionless exit strategy. After a breakout, the price doesn't always go straight up. This chart shows a throwback. About 55% of the time, roughly 11 days after the initial breakout, the price will dip back down to retest the breakout line. A throwback is a normal technical retest. As long as the price does not plunge back through the bottom, the setup remains valid. This dip provides a second chance entry point if you missed the initial breakout. A throwback tests your patience, but it offers a final opportunity to get in on the trade before the main rally begins. Let's review the complete workflow. Spot the wide, rounded Eve bottoms. Verify the middle peak rises at least 10%. Wait for the price to close above the confirmation line and set your target using the measure rule. This visual highlights the importance of the broader market context. Trade with the overall trend. The Eve and Eve double bottom averages a 40% gain in a bull market, compared to only 24% in a bear market. And above all else, adhere strictly to the trigger. No close above the confirmation line means no trade. By verifying the shape, confirming the volume, and demanding a breakout close, you transform a risky chart pattern into a structured system with a 4% failure rate.